Let's take a look at how we're doing this side of the world so far this Thursday. Interphrase not too well, given that heavy selling we had on Wall Street overnight. Sydney is off 2%. The Korean market is almost down that much. Tokyo is off more than 1.5%. About 13 minutes into trade. Let's get to our guest host this hour. Francis Tan is back with us, Chief Strategist Asia at Indo-Suez Wealth Management, joining me live around the desk here at the SGX. Francis, great to see you. Welcome back, and always a pleasure having you on the show. We were expecting a hawkish cut from the Fed. Were you expecting this hawkish, though? In the case of the change in the dot plots, the summary of economic projections, 4-2, plus the change in the growth outlook as well as inflation forecasts.
Right. I wasn't particularly expecting such a hawkish cut overnight. Mainly my initial expectations was for them to maintain their 4 rate cut projection into 2025, but yet providing some forward guidance in terms of a statement or a speech that the inflation seems a little bit more rigid or sticky, and that we need to be continues to be data dependent, but we will maintain the forecasts. But last night seems to be a little bit more than in fact what I'm expecting, or quite many of the people are expecting.
Is one way to look at this or read it, is this Powell being preemptive or protective ahead of Jan 20th, ahead of Trump?
Well, I suppose there's some element of that in that. And of course, if you look really at the data, some of the inflation components are a little bit on the sticky side right now. But of course, if you look at the inflation expectations, it also remains a bit sticky towards 2025 and 2026. So probably the observation of all this information, particularly inflationary expectations, prompted the little bit more hawkishness in terms of the forward guidance from the Fed right now.
All right, man's coming on this.
Yeah, absolutely. Let's bring it home. Let's bring it back to this side of the world then, Francis. What does all this information from the Fed mean for Asian markets?
Well, I will say that if you look at it, the Asian markets, or rather Asian central banks, have been looking towards these rate cut expectations, not just from the Fed, but throughout the world. And with that, particularly in Asia, we are seeing also a disinflationary environment across most economies in Asia. That initially prompted a lot of Asian central bankers to think that, okay, we can perhaps follow suit, and we shall also continue to be in this rate cut cycle. I mean, we have quite a couple of central banks meetings this week as well within Asia. But however, now seems to be on the reverse. The overnight US market performance already allow us to see that the market seems to be a bit more draggy right now, a little bit shocked by this hawkish cut that we saw overnight. And with that, I believe it will continue to come into Asia and further impacting some of the Asian sentiments.
Yeah, absolutely. I'd love to know what you think about what's going on in Seoul, because you've just come back from there, from South Korea, and naturally there's been the political crisis going on in the background as well. But I'd like to focus particularly on the currency side of things, given that now we've had this hawkish cut and commentary from the Fed, which has really shot the dollar to the upside above 108 for the DXY. What does that mean through the currency transmission of a weaker won for the BOK? Okay,
so if you look at the US dollar to the Korean won, it's two sides of one coin. On one hand, the continuous strength in the US dollar should move into 2025. Although, of course, whenever we see rate cuts, technically the US dollar should go lower, but it didn't, because this is a hawkish cut. And with the projection of only 2 rate cuts into 2025, the US dollar should have further strength, further room. So on one end of the equation, US dollar continues to strengthen against a basket of other currencies, including Asian currencies. Now, on the other hand, yes, I was in Seoul, but predominantly on the streets, the tourists are still everywhere. Everyone's still shopping, everyone's still eating, cramming, packing the restaurants. I do not get to see the protests or what on the streets, right? Because I'm just one of the normal tourists. But on the other hand, the domestic currency, the Korean won, is really a function of the confidence in the economic outlook into 2025. And now with certain more uncertainties, particularly in the political front, that will perhaps see some weakening expectations into the Korean won as well.
JP's going to jump in there. I do apologise. Sorry, I was waiting for Martin to jump in. My bad. Let's talk a little bit about China. Naturally, they've been doing their very, very best to shore up the economy through various announcements of stimulus to come. Increasing the budget deficit, you name it. At this stage, they're trying to throw some spaghetti at the wall and see what sticks. Is it enough?
Well, there's two schools of thoughts really when it comes to China. On one hand, investors who have been quite disappointed over the last couple of years of the Chinese equities or some of the assets are moving lower and somewhat non-response from the policymakers. They are continuing to think that, it's a bit too late, too little, and whatever is there in terms of the policy statements from the Chinese policymakers is a little bit too vague and not much in details. But of course, I belong to the second school of thought, whereby, we always hear this saying, no news is good news. In fact, to me, some news in China is better news. So I'm approaching 2025 with quite a bit more optimism right now, because over the past couple of years, when we are seeing the Chinese policymakers have quite a bit of a control, they decide, they were not going to tell too much about the economy, but for the first time, especially over the last weekend, when we see the statement from President Xi Jinping, he's putting the priorities of domestic consumption at the top right now. So that's number one. He also, for the first time, described Chinese economy as a winter economy, right? So I believe that all these are providing some signals from the policymakers to the rest of the market, or even to the rest of the world, that the policymakers now are pretty certain of the economic cycle of China, and they have got to arrest the slowdown or the very benign consumer confidence in order to boost or to protect themselves or against this new normal of more trade tensions coming up.
And perhaps we can talk a little bit more when we come back from the break, Francis, about what that means for your outlook for the Chinese equity market. But we do have to take that ad break, go earn some money with commercials. Francis Tan is sticking around. Hope you do as well. We're turning off to the break. Thank you so much for that preview, JP. Do stay with us and join in on the conversation. Let's bring back as well Francis Tan from Indo-Suez Wealth Management. What are your expectations, Francis, out of the Philippine Central Bank? And as we've got the Philippine peso testing record weakness at the lowest in decades, not to mention the pressure on other Asian currencies, how mindful do these central banks need to be when they're deciding on what they do with rates about causing instability in their currencies?
Oh yes, I'm sure one of the things that to be mindful of is really the currency impact. But the other direction will be to look at it in terms of that most Asian currencies are in fact depreciating against the US dollar. So it's a matter of more US dollar strength right now that we are seeing. So on one hand, if you are the BSP, I know you will be mindful of the weakening peso, but however, it's a general situation that we're seeing around in terms of Asian currencies. I will say that the main thing is to look into the expectations of 2025, whether the Philippines economy will continue to maintain at such a robust pace. Of course, we do see a little bit of on a year-on-year basis, a little bit of a weakening in terms of the economic outlook. Now, also the other thing to ascertain will be that for 2025, because of further or expectations of a more tariff against Asian economies, particularly in China, whether that will also impact the export sector of Philippines. So all these are several considerations that the PSP has got to think about.
But Francis, how closely are you watching some of these rate differentials? Because we know because of the emerging market space in Southeast Asia, maintaining that premium against the Federal Reserve's own range is perhaps paramount. If Jerome Powell decides that, hey, we're going to cut twice instead of 4 times next year, how does that complicate perhaps the decisions of these central bankers from Indonesia, Malaysia, Thailand, and the Philippines?
There will certainly be more some impact in that sense. I mean, when we look at rate differentials, it's not the coincident rate differential right now. It's the expectations of the rate differentials going into 2025. And now, as we were talking with Martin just now, that now although there was a rate cut by the Fed last night, but it's going to be a little bit more hawkish right now. We're seeing into 2025. So the expectations of the differential will be quite robust, and that already will be trickling down to further depreciating.
Are you surprised though that perhaps the ones behind the Federal Reserve, the Bank Negara Malaysia and Bank of Thailand, the ringgit and the baht are actually outperforming the ones that are above the Federal Reserve at the moment? Is this a bit of a surprise for you as well?
This is of course a little bit of a surprise right now, but of course at the end of the day, the country's currency is also dependent on their current accounts and the expectations of what they're going to do to their current accounts. One very interesting big longer-term trend is that although we are thinking that there could be a lot more tariffs going to China, right, it may be to a tune of 60%, but the continuous production fragmentation, that means production moving out of China, will continue. I mean, it has been happening over the last decade. It will continue to filter into the rest of our ASEAN regions, and that means more FDI flows. We have seen record FDI flows in 2023, 2024 should be another record
demand
year.
for those currencies.
Exactly. So that will be the one that will be providing a strong support for Asian currencies, in fact.
Good to know. All right, Francis, get back to you in just a little bit. Francis Tan there from Indo-Suez, and my great colleague JP Ong, part of the conversation as well. Let's bring in Jesper Cole, expert director at the Monex Group, and our guest host for the hour, Francis Tan. Indo-Suez Wealth Management is still with us. Plus, Lin, my great colleague, is joining in on this conversation. Jesper, good morning. Great to see you and appreciate your time. So, ahead of the Fed, we did a proprietary survey, which Lin, of course, was in charge of. And it showed a very slim majority was expecting the BOJ to stay put. That is not to hike today. After the events of the Fed overnight, though, especially the change in the outlook and the projection, the dot plot and growth, inflation, etc., do you still think they're going to sit on hands, or is this the cover that UEDA needs to maybe go ahead and continue raising?
Look, my view is that they ought to be increasing interest rates. The project of normalizing Japanese interest rates, is very important to continue. The economy is strong. The Prime Minister just gave a new fiscal support package, so there's no risk to demand slumping. And after all, with the Fed cutting and the BOJ normalizing interest rates, that's very good for capital markets because it allows private banks and insurers to actually start to make money on their core business.
All right, and I want to bring in a soundbite here from a guest we talked to earlier, David Seif over at Nomura. Let's take a listen to this and then we'll continue talking.
There's certainly been a lot of signals over the past couple of days from various news organizations that have signaled that they may not be ready to go today. Of course, it would be a very fast reaction just a few hours after the Fed to immediately move to that, to a hike. So it is certainly possible that it will happen today. But whether it's today or whether it's in January, that doesn't make a huge amount of difference, I would say, to what is the overall normalization policy that we really do see happening in Japan over the next, call it 8 months or so.
So yes, we're David Seif there from Nomura, whom we talked to earlier, chief economist for developed markets over there. And in another part of the conversation with him, he was saying that as a house, Nomura is expecting BOJ to end up hiking rates 2 more times. That is next year, 2025, which would leave the JGB at about 160 basis points. What do you think? Is that realistic?
Yeah, look, I mean, I think that this time next year, Japanese policy rates are going to be around 1.25%. But Martin, for today, we got to ask ourselves the more important question. We're being told, and the data confirms that the Japanese economy is on the mend, that the corporate metabolism is very strong, that inflation is reducing the purchasing power of Mr. and Mrs. Watanabe. And that as a result of that, the BOJ narrative is going to start to be put into question in the sense of that they tell us that if things proceed along the recovery trend, they're going to normalize interest rates. So when they don't do that, doesn't that send a signal that they are worried about a potential downturn here in Japan? That's something where I think market trust in the Bank of Japan over the next, actually today, as well as in the January meeting, is going to start to be tested.
Francis?
Yeah. Jess, I was thinking about the episode in terms of FX, the dollar yen. If you recall, back in August, September, it seems to be a bit of a fearful situation whereby it's telling investors that the yen is not weakening in terms of a one-way trend. The strengthening yen during that time caught everyone off guard. The reversal of the carry trade. Now, the only interesting thing right now that I hear a lot from investors is, will it happen again? Especially now we are looking at if the BOJ is going to hike and the Fed is going to cut rate into 2025. Will the reversal of this carry trade happen again and scare investors all around the world?
Yeah. No, and Francis, you put your finger on the pulse. I mean, again, the narrative that the BOJ is telling us is that the recovery is proceeding as planned. And as a result, they want to continue to normalize. Now, if they don't do that, then that, is going to put a big question mark in investors' minds. And as you know, the carry trade is still enormous. You can do the estimates whichever way you want, but if the Bank of Japan doesn't stick to its narrative, doesn't build confidence, amongst the investors that things are proceeding as planned here in Japan, which does imply normalization of interest rates, then that's going to put the yen, actually into a very, very dangerous position, potentially dangerous position.
So I guess, yes, but on that point, then why is the market pricing in that in all likelihood we won't get a move today? If the data is following in line, and Ueda said as much in that recent interview with Nikkei against its own projections, is it the Donald Trump factor here?
No, it's both, and you've got in America with Scott Bessent coming in as the Treasury Secretary, with Jeremy Powell at the Fed, and of course with the great Donald Trump, on top of things, you're going to start to see an avalanche of decisions being announced and being made in the United States come January. So if the Japanese, in contrast, just dither away and have this wait and see attitude on America, then of course what will happen is the yen will crash.
And yes, but as we round out the year, and of course we have heard from the Fed earlier today the expectation that we are likely to get less in terms of rate cuts. The BOJ, yes, they've said they want to normalize, but at that very slow pace. What is your outlook for the Japanese economy, for the Bank of Japan next year, and for Japanese equities as well?
So first of all, for the Japanese economy, the key point for investors is that the corporate metabolism, which is management buyouts, which is mergers and acquisitions, which is IPOs, which is investment spending here in Japan, the corporate metabolism of Japan Inc. is on fire. And that's what's going to drive very, very good earnings visibility. I expect corporate profits in Japan to rise by at least 20% in 2025. And as a result of that, the Japanese Nikkei very likely to go towards 55,000.
I want to look a little bit on the labor market condition in Japan. Now, at the end of the day, of course, if we do see rising wages, which we have been seeing over the last 2 years, that will trigger another round of consumer price inflation in Japan and perhaps prompting the BOJ to continue on their hiking path. So how's the labor market looking right now in Japan? Do you continue to see further wage hikes into 2025, prompting another round of wage price spiral upwards?
Yeah. And Francis, this is the key issue. Demand pull inflation is now appearing here in the Japanese economy. It's the first time in 30 years. It's not just the weaker yen putting up imported prices. It is actually a severe labor shortage, putting up price pressure. And the base pay negotiations, I've already started. They're going to be very strong. We could easily see a shunto of about 6 or 7%. And on top of that, labor mobility is on fire. You find that now the majority of companies is hiring far more people mid-career rather than at the graduate intake, which is completely new in Japan. And you actually find that for the people in their 20s and 30s, when they move jobs, the average pay increase is over 30%. So that's, where it gets exciting. Yes, you've got the old, retired baby boom generation living off their pension, not having a lot of purchasing power. But you've got a young generation in their 20s and 30s, who are seeing very great job opportunities, a pickup in labor mobility, and sizable pay increases as a result. So you and I want to be reborn as a 23-year-old Japanese.
Okay, so listen, yes, Press, probably good news, right, in light of the fact fact that Nissan and Honda look like they are trying to merge at least. I mean, who knows, right? There are always redundancies and job losses in situations like this. What do you make of that deal? How are they going to tie up or not? How closely?
Look, Martin, as you know, I'm super bullish on Japan, but I'm sorry, the Nissan, Honda, and possible Mitsubishi Motors merger thing is basically rearranging the deck chairs on the Titanics. I'm sorry, these companies, have neither the technology nor the capital, to actually create a new national champion that can compete. And let's be honest here, the competition is the relentless rise of the Chinese car industry. And as a result of that, you need, decisive new technology, decisive, charismatic leadership, and neither Honda, nor Nissan, nor Mitsubishi, and certainly not Renault brings any of that to the table. So yes, enjoy the ride. Nissan is being bailed out in this merger talk. It's terrible for Honda, but the 1 + 1 is going to end up basically being 0.5.
Oh dear. Okay, doesn't sound good. Jesper, listen, always great talking to you. Great value. Appreciate the time. You keep safe and warm. I know it's getting nippy up in Japan. We'll see you again very soon, I hope. And happy holidays if we don't see you. Jesper Kohl there from the Monex Group, and our guest host, Francis Tan from Indo-Suez, is going to be back with us in just a little bit.
Thank you for staying with us here on Squawk Box. Let's take a look at what's happening in South Korea as markets are reeling from the Fed's hawkish commentary earlier. Indeed, the Korean currency, the won, falling to its lowest level in almost 15 years, not just because of the hawkish Fed, but because of the dovish Bank of Korea. BOK governor saying that the country's economy may need more support due in part to the ongoing political uncertainty. Let's bring in our guest. We have Park Jong-hoon, Head of Career Economic Research at Standard Chartered Bank, and our guest host, of course, for the hour, Francis Tan from Indo-Suez Wealth Management, and Sherry joining in on the conversation as well, a cast of thousands. So Jong-hoon, thank you very much for joining us today. How well equipped do you think the Bank of Korea is to be able to stabilize, steady and shore up the Korean economy during this uncertain time?
When you look at it historically, there has been 2 impeachments in Korean history, and the Korean economy actually did okay during the impeachment period. I think it was because of the external environment actually pretty good in 2004 and 2017. And also like the government policy and also the BOK's like a dovish kind of stand supported the economy. So if for this time, if the government come up with like a supportive budget to support the economy and the BOK cut the interest rate to support the growth, then probably at the end of the next year, we may see the growth in 2025 was actually not bad, even during like a pandemic period, I think. Even the impeachment period.
BOK governor talked. Right. And the BOK governor called for a prompt introduction of extra budget. I think that really moved the needle for the bond market yesterday, although yields are coming back up on the back of a hawkish Fed this morning. How feasible is it that we get an extra budget? Because it's become highly politicized at the moment, given the martial law, given impeachment as well. And how would it be priced in the rates market?
I think the supplementary budget is highly likely. I mean, even the government thought like the next year budget is smaller than they initially suggested. So we need like a supplementary budget next year. And I think right now, like the opposition party, which is a majority party of the National Assembly, is controlling all the policy agenda, and government has the incentive to boost the economy. So I think the fiscal additional budget is more likely only next year, and that is going to support economic growth. So, I mean, historically, if there's a 10 trillion won for the supplementary budget, supported economic growth of 0.1%. So I think the government has reason to push like a supplementary budget next year. Then I think that has to be funded by the issuance of the KTB. That is going to give pressure to the rates market. So that has been historically 1 trillion has been driving up around 1 BPS of the interest increase. So there is a pressure for a bit of the rate increase, but the Bank of Korea is continue to cut the interest rate to support economic growth. So I think that is going to balancing out the rates market, I think.
We've got the next BOK meeting on January 16th, I believe. Do you see a third one, a back-to-back rate cut I'm talking about? Because some were talking about inflationary pressure coming back up, especially when it comes to Korean strawberries. I mean, gotta love Korean strawberries, cocoa prices, and coffee as well.
I think it's going to be depend on the Korean won stability up until the BOK meeting. So I think the BOK obviously want to cut the rate to support economic growth, but the financial stability, especially in the FX market, is going to be a key concern. I think the household debt is not increasing, so the only concern for the BOK at this time is going to be the FX market, and I think MPS is going to decide where, how they're going to use their FX swap with the BOK. So if that all the kind of government policy or MPS policy stabilize the FX market, I think there is we have to be open for the a January late cut. I mean, our base case is a February cut, but we need to be open for January cut, and I think that is going to depend on the data we collect up until first week of January.
Hey, Jong-hoon, thank you very much. While Sherry mentioned about Korean strawberries, I'm going to talk about Korean cars instead. And earlier we had a guest from Japan. He's talking about the potential merger of Nissan and Honda. I was also in Seoul just earlier this month, and I was looking at the amazing technology that the Korean cars have. Now, looking into 2025 or even beyond, what do you think of the onslaught of the challenges or the opportunities that these Chinese car makers have onto the Korean car industry? Because it's quite a big part, other than semiconductors, of course, and the other parts of electronics, it's quite a big part of the Korean economy, not just because its contribution to the GDP of Korea, but also because of its employment of Koreans. So what do you think about the next couple of years in the car industry?
I think it's going to be quite challenged. I think right now, as you mentioned, the car has been the main driver for Korea's growth, but the Chinese competition is getting severe, and I think that also even 2024 the auto market was pretty okay, but there is going to be some downside risk for 2025, and I think the challenge is actually getting rise. I think the overall sentiment for the auto industry is not going to be as bright as the previous years. I think the key concern is going to be what is going to be the next sector Korea can get into. So AI innovation is going to be the key theme for Korea. So even for auto industry, how we are going to mix AI and the auto industry into together and provide some more AI-driven kind of auto industry. So I think that's why we hear some a cooperation between the Samsung Electronics and the Hyundai to cooperate to build next generation cars.
It's been really great to have you on the show. Thank you so much, Park Jong-hoon from Standard Chartered, and a big thank you to our guest host of the past hour, Francis Tan from Indosuez. We'll be back with the home stretch of Squawk in 2.